Welcome back to All Things Money. I'm David Blain, and during today's show, we're giving an overview of the Federal Reserve System as well as discussing a very important two-day meeting that starts today, November the 2nd, in Washington, D.C., a meeting of the Federal Reserve with Election Day. This has not received the press that maybe the election has, and so we wanted to bring you up to date on what is going on. As always, if you missed the first part of the show, log on to the web, www.dlblain.com. There you'll find archives of the show. We also welcome your comments and questions. Our phone number is 252-633-0107. Our email is allthingsmoney@dlblain.com. And if you have any comments, questions on today's show or any other financial topic, we'd love to hear from you, and we'll try to get your question or topic covered in a future show. As I mentioned, today we're discussing the Federal Reserve, talked a little bit about the creation of the Federal Reserve, talked a little bit about specifically Thomas Jefferson's warning against a strong, powerful central bank. In today's world, unfortunately, virtually all the countries around the world have this central bank type system. Don't know that there's really any easy way to get out of it. We're kind of stuck with it. So what I want to do is to make you aware of how the Federal Reserve works, some of the very important decisions that they make that impact every citizen's daily life. So during this two-day meeting that the Federal Reserve started today, they're expected to conclude with some announcement of a somewhat unorthodox plan to spark life into the U.S. economy. You may have heard the term QE2 bantered around in the media, maybe CNBC or the newspaper. Well, it stands for Quantitative Easing 2, and it's sort of a play on the cruise ship, the Queen Elizabeth, this massive cruise ship. Well, this is supposed to be a massive quantitative easing. And what exactly is quantitative easing? We'll get into that, but simply it's the Fed, through the purchase of securities, putting liquidity into the marketplace in the hopes of stimulating the economy. And what they're going to try to do is purchase bonds, U.S. Treasury bonds on the open market to help drive yields down. You may think that sounds really strange, the government buying their own government bonds. That's way beyond the scope of today's show, but suffice to say the Federal Reserve is responsible for setting monetary policy, but it does not print the money or issue treasuries. That's the Treasury Department that does that. So the Fed has money and it can purchase U.S. government bonds, and that's what they've announced that they're trying to do, is to, when they purchase bonds, as hopefully you remember from other shows, when the price of bonds are simply determined by supply and demand, and when you have a lot of demand for them, it drives the prices up, and yields move opposite in bonds to the price. So if the price goes up, the yield goes down. And so the Fed, by going out in the marketplace and purchasing U.S. government treasuries, they're hoping to drive yields down. Now, why do they want to drive yields down? Well, a couple of things. Number one, it helps stimulate the economy by, frankly, if you're not earning anything in your savings account, you're not earning anything in short-term money, it encourages people to put their money to use in other productive ways, such as the stock market, investing in businesses. It also helps drive down mortgage rates, so maybe people, instead of keeping money in the bank, will go out and buy real estate, either a new home or investment property. So they're hoping to drive down the yields on the safest investments to free up some of that money to go out into the economy and invest it. A couple of anticipated things that will come out of that. Number one, the dollar is expected to weaken from the Fed's action. Purchasing, I believe they're going to be targeting 2-year and 10-year Treasury notes. That will also have the effect of boosting demand for U.S. products overseas. As the dollar drops in value, it makes U.S. exports more appealing to foreigners. So if someone in China or Germany or somewhere, if the dollar is dropping relative to the euro or the yuan, then it makes U.S. products more attractive and hopefully would encourage foreigners to buy U.S. products and import rather than so many exports. Of course, the British, European, and Japanese will certainly probably take up some action after the Fed meets, and so it may have a negating effect if they also take these similar steps and their currency lowers. It may have a marginal effect. So that the risk of all this sort of priming the pump is that you're going to have higher inflation down the road. There's considerable skepticism about whether quantitative easing will work. Some of these policies come from the Keynesian school of economic thought. A lot of this is new and being tried for the first time in this particular situation. It's been used before, but after such a massive financial crisis, they're in virgin territory, so to speak. It seemed to have worked to pull us out of the financial crisis. There's a lot of debate about, bailing the banks out and things like that. The fact of the matter is, at least on a short-term basis, we did avoid a complete global financial collapse. And so the question is quantitative easing going forward the right thing to do? Well, we'll take up that topic when we come back from the break. For All Things Money, I'm David Blain, and we'll be right back.